Alright, so the market just went from extreme fear to cautiously optimistic in hours after market close. And here's what actually happened. Nvidia dropped earnings that basically told every AI bubble bear to sit down, while the Fed minutes earlier are still screaming we're not cutting rates like you think we are. Look, if you're short on time or just stumbled on this channel randomly, the takeaway is this. We're entering a period where tech and AI stocks can rip higher on strong fundamentals, but the broader market is going to stay choppy because the Fed is getting cold feet and the consumer is showing real cracks. So it's not a clean bull market, it's a knife fight where only the strongest names survive. Stay with me here, I'll walk you through exactly what the Fed said, what retailers are screaming about, and why Nvidia's earnings call was basically a middle finger to Michael Burry and the AI bears. So, quick introduction for anyone new here, I'm DataCat. This channel's about 4 months old now, and honestly, judging by my subscription and view numbers, I'm still figuring out the whole YouTube thing. I'm an introvert, so talking to a camera feels weird, but here we are. I spent years as an analyst inside a Fortune 50 company. Think messy data, meetings that could have ended with one Slack message, and documentation in Confluence that nobody read. Eventually, I traded the corporate grind for, well, lasers and keyboards. Now I just break down markets and data without someone breathing down my neck about slide formatting. I don't make bold predictions or tell you to buy courses. I'm just here to help you understand what's actually happening beneath the noise. Think of me as your slightly cynical guide through the financial circus. If you are into this kind of thing, please hit that like and subscribe button before my cat comes complaining why I'm not out for work right now. So, before we get into the Fed and Nvidia, quick context. Earlier this week, we talked about how the market was looking choppy and slightly bearish heading into this stretch. And that was pretty accurate. We've been grinding lower. The Nasdaq went on its longest losing streak in about 3 months, and sentiment got absolutely crushed. Fear and greed index hit 11, which is basically extreme fear territory, similar to April this year. The kind of reading where everyone's positioned for the apocalypse. Then Nvidia reports after the bell, and suddenly the after-hours tape looks like someone flipped a switch. But here's the thing, the relief you're seeing in tech names is happening against a backdrop where the Fed just told us they're way more divided than anyone thought. And big retailers are basically waving red flags about the consumer. So let's unpack this mess, starting with what the Fed actually said in the minutes from their late October meeting. And it wasn't pretty. Here's what we learned. There are strongly differing views inside the committee. Not just some disagreement, but strongly differing. That's Fed speak for, we're kind of arguing behind closed doors. Many participants, and that's Fed language for a significant chunk of voting members, said they think no further rate cuts are needed in 2025. We're talking about a scenario where the Fed just stops cutting after maybe one more move, if that. Only several participants thought another cut in December might be appropriate, and even then only if the data weaken enough. Several is a smaller group than many, by the way. This is the Fed's weird way of telling you the math doesn't favor more cuts. Now why are they so cautious? Powell said it himself. They're dealing with a data vacuum because of the 40-plus day government shutdown. He called it driving in the fog. And when you can't see where you're going, you don't slam on the gas pedal. Or in this case, you don't aggressively ease policy. So, what did the market do with this information? CME FedWatch, again if you're new to this stuff. This tool tracks where traders are betting rate cuts will land, dropping the odds of a December cut to around 30%. That's another sharp decrease from where we were just a day ago. Now personally, and this is just my read, I still think there's a decent chance we get one more cut in December. The Fed doesn't love surprising markets, and the rhetoric could shift if the next inflation print comes in soft. But my opinion aside, we have to acknowledge why markets hated these minutes. First, equities sold off. The S&P 500 and Nasdaq slid after a rally at open, and rate-sensitive stocks like SoFi got hammered recently because fewer rate cuts mean higher borrowing costs stick around longer. Second, bond yields and the dollar moved higher. When the December cut is coming narrative gets punctured, money flows into bonds expecting higher yields, and the dollar strengthens because higher rates make it more attractive. Here's the bottom line on the Fed. The direction is still toward easing compared to 2024. But the Fed is sending a very clear message. We are not in a rapid cut cycle. Everything is data dependent, and we are willing to sit tight if inflation doesn't behave. And that raises a real risk, a policy mistake on the hawkish side, meaning they stay too tight for too long, and by the time they realize the economy is weakening, it's too late. That's what markets are wrestling with right now. It's like watching your cat sit on the edge of the table, while staring at a glass of water. You know something bad might happen, you just don't know when. Alright, so while the Fed is out here playing cautious, we're also getting a flood of earnings from big retailers this week. And the story is not great. Let's start with Home Depot. They beat third quarter sales, which sounds good, until you realize they also cut their full year profit outlook and forecast a steeper drop in annual profit. Why? Americans are delaying big remodeling projects. High borrowing costs and a still muted housing market mean people aren't dropping 10 grand on a kitchen renovation. They're buying paint and fixing the leaky faucet, but the big stuff? Nope. Then we also got Target. Comparable sales down 2.7%, worse than the expected 2.1% decline. They're planning another $1 billion investment just to try and revive sagging sales. Management pointed to weaker discretionary demand, same pressures hitting Home Depot and Lowe's. Speaking of Lowe's, same story. They lowered their profit outlook, citing consumer caution on big projects. Smaller maintenance spend is holding up, but anything major? Forget it. So here's the synthesis. The consumer is in muddle-through mode, with clear cracks forming. They're still spending, but trading down. Cheaper brands, smaller pack sizes, more store brands instead of name brands. People aren't stopping spending outright, they're just being way more careful. Big ticket items tied to housing, furniture, appliances, renovations are weak. But essentials like food and household staples, those are holding up better, especially at value retailers. More importantly, the low and mid-income consumers are under real pressure. Higher rents, food costs, utilities, and now you've got tariffs on certain goods plus still elevated interest costs. Household debt is near record levels, and delinquencies are drifting back toward pre-pandemic levels. The corporate language has turned clearly more cautious. Home Depot, Lowe's, Target, all of them are explicitly calling out hesitancy on big purchases, pullback in discretionary categories, and increased hunger for promotions. This is not a collapse. The consumer isn't dead, but this looks like a mid to late cycle stretched consumer. The engine's still running, but there's way less cushion, especially at the low end. Okay, so heading into Nvidia's earnings, sentiment was absolutely destroyed. Fear and greed index at 11. Extreme fear. The narrative going into this print was dark. AI spending is peaking, the AI bubble is bursting, hyperscalers are going to pull back on capex, custom chips and ASICs are going to eat Nvidia's lunch. Michael Burry's probably been sitting there with a smug look, waiting for vindication. And then Nvidia reports. Revenue beat, guidance raised, $57 billion to $65 billion for next quarter. They laid out $500 billion plus in revenue visibility through calendar year 2026 for Blackwell and Rubin architectures. And then here comes the real story. It's not just about one good quarter. Nvidia's earnings call fundamentally challenged the bear narrative. First, they made it clear this isn't a one-off training boom. The narrative shifted to inference as a heavy ongoing compute workload, and then they dropped the hammer, agentic AI. These are thinking models with chain-of-thought reasoning and planning capabilities, stuff that requires massive compute, not just for training but for inference at scale. Second, they're deepening strategic ties with OpenAI, Anthropic, xAI and others. This reinforces CUDA lock-in, meaning even if competitors try to build custom chips, the entire AI development ecosystem is built on Nvidia's platform. That's a moat. Third, the ASIC and custom chip threat. Nvidia basically said, yeah, good luck with that. The complexity and cost of building competitive infrastructure at this scale is prohibitive for most players. So what does this mean? Nvidia's print temporarily removes one of the key tail risks weighing on the market, the AI capex cliff or bubble pop scenario. It doesn't mean the bubble can never pop, but it's not popping right now, and the runway looks a lot longer than the bears thought. And honestly, this earnings call was basically Nvidia giving Michael Burry the finger. Not in a cat's mean way, just in a hey, we see your short thesis, here's 500 billion reasons why you're wrong kind of way. Cats can be gentle, but when we knock your cup off the table, we make eye contact while we do it. Alright, so where does this leave us? Same old, same old. We've got this classic tension. On the macro side, a more hawkish Fed, a slower and stressed consumer, higher yields, and a repricing of rate cut expectations. On the micro side, Nvidia and the AI trade just proved they're way stronger than feared, and the bubble narrative took a serious hit. So how does the market behave from here? Here's my read. In the very near term, next few days, odds favor volatility with a bullish bias, but it's going to be narrow. Why? Sentiment was at extreme fear, positioning was defensive, a lot of de-risking already happened. Then you get a massive positive surprise from a market leader, and historically that triggers short covering and FOMO. We'll probably see sharp upside moves in Nvidia, AI semis, data center plays, and mega cap tech. The Nasdaq might bounce hard. But, and this is important, the bounce is going to be led by a narrow group. AI, mega cap tech, maybe some cloud names. Broader cyclicals, small caps, consumer discretionary. They're going to lag because the Fed and consumer picture is still uneasy. The Fed minutes cap the upside. Even if Nvidia saves the AI trade, the fact remains. Fewer near-term cuts, higher real yields than what equities were discounting. That's a continuing headwind for long-duration unprofitable growth stocks, rate-sensitive sectors like real estate, and consumer names tied to big-ticket spending. So instead of a clean V-bottom where everything rallies together, the more realistic path is this. High volatility, sharp rallies led by AI and growth on good micro news, but those rallies get repeatedly tested by macro worries. Rates, consumer data, Fed rhetoric. It's a tug of war. And how long it lasts depends on 1. The next inflation prints and jobs data once the government shutdown backlog clears. 2. Walmart's earnings and guidance, which will either confirm or soften the consumer is weakening story. 3. Subsequent Fed communications. Do they lean into the hawkish tone or walk it back? Think of it like this. The AI bubble is popping now story just got punched in the face. But the Fed is higher for longer, and the consumer is cracking story is still very much alive. So it's not a one-way crash, but it's also not a clean bull market. It's a knife fight where only the strongest names, those with real earnings, real growth, real moats, are going to thrive. If you're positioned in AI and mega cap tech with strong fundamentals, you're probably feeling pretty good right now. If you're holding speculative, unprofitable, rate-sensitive stuff, you're still in the danger zone. Alright, that's the breakdown. Nvidia just saved the AI trade, at least for now. But the Fed is tapping the brakes, the consumer is showing cracks, and the market's gonna stay choppy with narrow leadership. Stay nimble. Don't chase garbage just because the indexes bounce. Focus on quality. Focus on names with real earnings power and pricing power and be ready for more volatility. If this was helpful, let me know in the comments. I'm still figuring out this whole YouTube thing, so feedback actually helps. Oh, yeah, hit that like and subscribe button too. Alright. That's it for today. DataCat out. Stay safe and stay sharp out there, and I'll see you in the next one.